is BQ Prime. To say that small cap funds have been the flavor of the season so far this year would be to put it a little mildly. I was looking at the flows data that is shared by AMFI for the first few months of the year, and I look at till the month of May, around 18% of the total inflows into equity funds has been into small cap funds. About 14% has been into mid cap funds. And if you compare that with the same period last year, only about 8% or thereabouts went to small cap funds and about 9.5 went into mid cap funds. And that has been accompanied by a significant outperformance of small cap stocks as well. That is reflected in the performance of some of these funds in the year-to-date period. But should that be a reason for you to start investing in them? Perhaps not. We'll talk about the context. We'll talk about where it fits in your portfolio. And we'll also talk about fixed income, because that also is the flavor of this month, with the Fed policy meeting just a short while away, or the outcome of that meeting. Joining me is Shalini Dhawan, Director and Co-founder, Plan Ahead Wealth Advisor, as well as Santosh Joseph, founder of Germinate Investor Services. Thank you so much to the both of you for taking the time. Let's start with the most basic question, which is, what are the key aspects of the category small cap funds, and where do they fit in your portfolio? Shalini, I'll go to you first.
So I think it's kind of very clearly defined now. SEBI has as you would know, and investors will know, SEBI has classifications, clear classifications on what would be called a small cap scheme. And the small cap scheme basically needs to have about 65% of its money in small cap stocks. And therefore, that the question that comes up is that what is a small cap stock? Here again, there is kind of a clearly defined universe. So the Association of Mutual Funds of India, AMFI, does have a listing which basically speaks about the market capitalization of different stocks. And if you take the 251st stock, let's say on the exchange, the 251st to the 500 is what we would call as the small cap universe. Typically, market capitalizations would be around, say, 10,000 crores for some stock which is around the 251st level. And then you would go down to somewhere in the 500 stock would be a market cap of around 5,000 or 6,000 crores. So that is the kind of size of the stock or the company that you're looking at when you're making an investment into a small cap scheme.
Okay, so that kind of covers the universe. But I also want to talk about a few other aspects, and perhaps you can talk about them, Santosh, in terms of the propensity, I think, of fund managers to have a larger basket of stocks that they invest in. You would generally see a much larger portfolio. The holdings are generally smaller. Why do you think that is?
I think there are two reasons for it. Number one, the universe for small cap stocks are fairly bigger than what you look for a large cap and mid cap. For example, by the explanation that just Shalini shared, the top 100 are large cap, the next 100 are mid cap. Whereas when it comes to small cap, there's a much larger list, number one. Number two, because of the liquidity that these stocks have, which is actually less liquidity compared to mid cap and small cap, depending on the size of the fund and depending on the opportunity that there is at hand, the need to have a slightly longer list of stocks in the small cap becomes a essential part of the portfolio. And even the exposures that they have is going to be, at some level, a derivative of the total assets under management in the scheme. So at one level, you have more number of stocks. At another level, you have a liquidity factor to play for. And the third important aspect is that because of the large number of stocks available and the derivative of the size of the fund, you will have to play a slightly larger number of stocks in the small cap portfolio basket.
So we've seen a lot of flows into these small cap funds. Is it simply money chasing returns in this case? Because you've seen quite a few small caps perform very well in the year-to-date period.
Yes, I believe recent performance would have some bit of an impact when investors are looking at what kind of schemes to invest in. And if you see the year-to-date performance of small cap schemes in the range of around, as a category, they've been around 7%, but some have even given double-digit returns like 11, 12% absolute. Now, when you compare that to your large cap schemes, which are in 2-3% kind of range, then obviously small cap schemes look attractive. So there would be a bit of a recency bias there. I would also add another, item that one or probably investors may be considering is the fact that mid caps have actually, small caps have actually are now actually trading at the long-term valuation, very close to their long-term valuation as compared to if you look at large cap schemes or if you look at mid cap schemes. They are still a little bit away from, or they are a little bit more expensive if you compare their long-term valuations from a forward P perspective. So that could be another reason as well.
How much of a factor, Santosh, does the distributor community also play into this? Because, of course, that narrative kind of creeps in, and you want to obviously be in the top quartile.
I think at the distribution level, the point that we were looking forward to is that both mid cap and small cap index were lagging the large cap or the broader index for some time. So while small caps did stage a recovery and flow started catching up, in spite of that, we saw there was a valuation gap in terms of the all-time highs of the mid cap index and the small cap index. So you had a green shoot of performance kicking in since maybe Feb, March. You add to that the valuation was comfortable and attractive, especially over the last year or so, we were in a sideways market. It was the perfect recipe for smaller mid caps to take off both in terms of equity flows in small cap and even the return. So sometimes, you go through that short periods where returns will attract more flows, and more flows will actually take the returns higher because it's small cap and, there's a shortage of liquidity. There are only so many finite very good small caps, and therefore that will drive the prices even higher and therefore lead to greater performance.
Basically, we were talking about the 5 outperformers and the underperformers, and the fact that there's a very substantial gap. Why do you think that is?
So I would probably attribute it to a couple of things. I think, like we discussed, the small cap universe is huge in that sense by definition, but there would be a lot of expertise here between fund management, invest management, and the team in terms of trying to understand stock selection, sector selection, and so on. And how does the overall India macro story fit in? What kind of sectors and stocks that would a small cap fund manager actually look at? Just to give you an example, there could be a case, this is just some data that we were reading or evaluating. There could be a case where, one outperformer scheme actually gave a miss to a certain stock in a financial services sector, and that could be the reason for its outperformance. And on the other hand, the other underperformer scheme could actually have added more weightage to a certain stock, and this could be financial services, or it could be energy, or it could be any other sector that we are talking about. So I think quite important for a small cap scheme investor to look at how the fund is managed overall, what is the expertise, what is the fund manager history.
Right.
I'm sure a lot of that counts.
Absolutely. Santosh, you want to weigh in on this? The fact that there is a big divergence, and this is in a very short period. The reason I picked the year-to-date period, and normally you wouldn't do that, is that you saw a big change in the flows around that January period heading into May, right? So how would you evaluate, first of all, over what period? You would obviously look at rolling returns, but then would you have any insights as to why you've had such a great degree of outperformance and underperformance?
See, to begin with, I think they were offering value at one point, right? There was a broader market at one level of valuation, large caps at another level of valuation, mid and small caps were available relatively cheaper than the broader market. So that's the first paradigm. Second is about the stance of the portfolio. Now, within small caps, we've noticed that thanks to what we went through the entire 2022 calendar year, it is normal for a portfolio manager to go into the conservative mode of conserving capital or avoiding further drawdown on the portfolio. Now, the third part, as you know, since you have a wide array and a longer list of stocks, the people who are concentrated can go through the challenge of errors of omission and commission and miss out some good stocks and buy something which didn't perform. Now, the guys who did perform, if you look at them, they played the small cap stance and the strategy to the hilt, which is they bought as many as stocks as possible, maybe with slightly differing weights, and they played the small cap to how a small cap should be played aggressive, overweighted on some of the stocks and sectors that they like. Now, when you look at the year to date or even a particular month, like let's say April and May, which have been particularly good months, notice that the market itself saw a lot of activity in the mid and small cap space where for a second, the large caps which controlled the whole of 2022. Most of us know that the whole of 2022 calendar year, 8 to 10 stocks controlled the market. Whereas now you had many small and mid cap stocks participate in the market activity. That's why you saw the year to date and couple of months have an outperformance because you had a massive participation by mid and small caps.
Fair point, and very clear evaluation of why you've seen that performance. But then it brings us to the most important point, I think, which is how do you evaluate? Because you see these periods of sharp underperformance, sharp outperformance, and I think particularly in small caps, you find that kind of lumpiness in your return profile over a longer period of time. So therefore, how do you go about selecting the right fund for you? And where does it fit in your portfolio, Shalini?
I think for fund selection, like you mentioned previously, rolling returns is a good idea, not necessarily for small cap, but as a
practice
asset class or equity or as a practice, it's good to have rolling returns. They allow temporary bursts of outperformance or underperformance, get rolled out in that sense. So long-term rolling returns are a good way to look at it. They also capture different business cycles. So if you're taking 5, 7, 10 years rolling returns, they would have even taken the entire COVID and all the Ukraine war kind of geopolitical events that happened. So rolling returns would be one way. Another item to look at, as I mentioned previously, is fund manager experience, fund manager history. We also do look at risk return ratios. These also help investors understand if the scheme fund manager has taken undue level of risk in delivering that return to you. And of course, last but not the least is expense ratios, peer group comparisons on how, the returns stack up versus expense ratios. And of course, consistency would also come by when you look at rolling returns.
Okay, so that kind of sums up all of the aspects that you'd want to watch out for. And it's quite a long list. But
yes.
Would you want to add anything to this, Santosh, with regard to the key metrics to watch? I think this more or less covers it. But then where does it sit in your portfolio? And should you kind of get attracted to it? The worry here is you've seen a degree of outperformance in the year-to-date period. And the tendency would then be to chase after that and have a slightly wider or larger allocation, which not necessarily the best thing to do.
So before I answer, let me give a very interesting perspective about small caps. Now let's take a slightly larger time frame, like a 10-year period. Now, when you take a standard 10-year period and when you take a small caps performance, right, the best large cap performance will be equivalent to the bottom small cap performance. I'll repeat. The best of the best large caps funds performance will more or less match the bottom rung small cap performance, which means the top performer in the small cap will be 2x or maybe even 3x of that performance. So let's take last week's data. The best large cap on a 10-year basis is given you between 15 to 16%. The worst small cap on a 10-year basis is given you, the worst one, mind you, 15 to 16%. Now the best small cap has gone on to make over 20% return on a 10-year period. Now, that itself is proof that Small caps are an integral part of the portfolio. Well, it comes with a sense of what we call lumpiness in returns or volatility. Now, once you understand, the 10-year story is clear. The short term is where you're worried about. You start now allocating the right process and the right percentage into the portfolio. Now, if you're someone who's staggering or doing an SIP as the small cap equivalent to your portfolio, you got nothing to worry. You should be happy. On the other hand, if you're someone getting in at one time, you have to be careful of the valuations. I think for a seasoned investor, by now you must have figured out that you buy small caps when nobody's looking at them and the 1 year return is probably negative. Right now, when you look at 1 year return and 3 year return and 5 year return, the story is slightly different. So you're at the crux of another big turnaround in terms of small and mid caps. So I don't think you have to make it more complicated than it is. It's simple. Small caps are integral part of the portfolio based on an individual risk appetite. You decide whether it's 10% or 30% of the portfolio. Nobody goes 50 or 70% in small caps. Everyone knows the pros and the cons of it, and you usually go into a multi-cap structure for your overall portfolio.
All right. So you made that point very well about staggering your investments, and to take that point on lump sum investments forward. If you use an STP, of course, you can stagger your investments over a period of time. But to come to the point where I think a lot of people have tuned in for, which is to identify which schemes you both like. And I'll come to you first, Shalini, for your list. You've obviously studied this over a period of time. What's your list?
So I think I mentioned it, by compliance, not able to answer that in specific terms. But like I mentioned, I think our vote would possibly go to some names which are having a longer term, consistent track record. Investors would need to kind of do their homework around this. There are quite a few names which have even, like Joseph mentioned, like a 10-year track record. So some of those names, and of course, within that we can watch out for schemes which have higher, fund manager history, experience, and of course look at returns data, look at risk data, and I'm sure investors.
Yeah, fair point. Santosh, do you have a few that you can talk to us about?
Yeah, before that, let me tell you, I'll make this exercise easy because everybody wants one or two funds when we can all invest and make money. But in small caps, you actually have better chances of making money because that universe is more important than the brand or the scheme that you pick, right? Like I explained to you, that the best small cap will outperform the large cap by a multiple margin. Now here, true diversification in a mutual fund scheme happens only in small cap. It happens a little bit in mid cap and probably never happens much in large cap because the stocks are common.
Yes.
So even if you bought the 3 or 4 schemes, depending on the size of your portfolio, you're truly diversified because each guy has got different stocks and some will not have it and some will have it. Second, even their weights are tangentially different. If you look at the top 10 in most small caps, it's not going to be same like how you watch a large cap or a mid and large cap. So therefore, the first thing is, if you like 3 or 4 schemes and you're confused, buy all the 3. Don't buy the needle in the haystack, buy the haystack. You will benefit, right? Number one.
Yeah.
Number two, I would also be a little wary about the size of the fund. I like it to have a longer maturity in terms of at least a 5 to 10 year track record. But if I today find the size of the fund at 1,000 to 3,000 or maybe even 5,000 crores, I'm more or less going to be, veering towards a smaller fund because in small cap, the percentage exposure you take really matters a lot.
Yeah.
So I normally go with a slightly smaller size. Now also remember, the guys that performed well over the last 5 and 10 years may not necessarily be the performers over the next 5 or 10 years. So if you notice, all these 3 points that I made will make redundancy of any recommendation that I give you that, buy X, Y, Z or don't. Yeah. But otherwise, thanks to Nippon, HDFC, Tata and Franklin being familiar names and having a good track record, great investment processes, it's a great, bet to jump into at least 3 schemes.
Fair point. And that's an interesting strategy because that in a sense is what the small cap strategy is all about, which is to diversify your holdings, and there will be performers within that group. I think we've kind of covered most of the aspects with regard to small cap, but I also on today's conversation wanted to delve a little deeper into fixed income because I think we might just be at a crossroads where you could see the Fed hitting pause later in the week. And that kind of might be a signal for the rest of the central banks across the world. Of course, you had the RBI Monetary Policy Committee last week hitting pause yet again. And the question I think here that some people have started asking is whether or not you'll see a rate cut sooner rather than later. But then how do you position your fixed income holdings right now is the question that I'm asking. And I'll come to you first, Shalini, on this one. Particularly if you're talking about the shorter end of the spectrum and you're talking about, say, your contingency fund, which the thumb rule for the longest time was just buy liquid funds because it's the most convenient option. The tax aspect of it was conducive. That has now gone away. So does your strategy change?
So again, this would be a little contextual to depending on, what all, which tax bracket the investor is into. Does the tax law make a big difference? Many a times contingency funds specifically are actually, like a long buy and hold kind of money put away. And therefore, I think in some cases, the strategy would probably still remain liquid funds, but it could also move to, if you're looking at, goal planning specifically, and where people are looking at, let's say 6 months, 1 year horizon for emergency purposes, we'd also look at arbitrage from that perspective, given the tax bracket. So that could be another way, but otherwise, broadly, I don't think tax should be that big, an element. I think we'd probably be more conservative about it.
Fair point. Santosh, you want to weigh in on where we stand with regard to the interest rate cycle? Generally, I think it makes sense to play that cycle because it kind of is predictable, kind of.
We are actually at crossroads, and you rightly put it that way because, we had a pause last week with our central bank. US may also go in for a pause in a few hours from now. And in a few hours from now, when ECB meets, they may actually go in for a hike and actually narrow the gap because today, right now, the gap between the ECB and the American markets is 150 basis that may drop to 125 basis. Yeah. So, and China is going for a rate cut, right?
Yeah.
And so therefore, you are at a crossroads where different economies are now saying, I will not use a blanket approach. I will use what works for my economy. The Fed chairman very clearly said that there is going to be a lag effect of the previous hikes that have already happened. Now, in India, for 4 months in a row, we've had CPI inflation actually show signs of cooling off. So therefore, I think either we are at the peak of the peak interest rate cycle, or maybe we are looking for some more key indicators to say that we're somewhere around that levels. Having said that, I think if you were to talk about contingency or emergency, my practical experience over the last many years has taught me that if it's really contingent, keep it in your bank account. Forget about an FD, forget about liquid fund, forget about anywhere. It's that whether it's 50,000 or 2 lakhs or 5 lakhs, whatever the contingency for each individual person that relates to, please keep it in the most accessible format that you like. Over and above that, you have to start looking at the applicability or the need for the fund. And therefore, you'll notice that liquid and the money market and the short term or the ultra short term come into play, because then you want to ensure that the money that you have will be more or less parked into the duration that the fund offers. Now, let me also add another important point here, that sometimes even in fixed income, people chase returns. If ultra short is doing well, they want to go there. And if liquid is lower, they don't want to park over there. That's again a mistake that you should avoid, because you should know that there are risks even in fixed income between long duration, short duration, and liquid and money market. Ideally, go in for strategies that will be aligned to the need of the fund that you have. As far as the longer term debt is concerned, I think it makes sense to be between the 2.5 to 3 year maturities, because if you're looking at coming off the peak interest rates, you may have some bit of luxury to lock in money at a decent yield and also benefit from capital gain as rates go south.
I think that kind of is the clincher for the fixed income conversation as well. Both Shalini as well as Santosh, thank you so much for joining in. It's been a comprehensive conversation, I think, and perhaps we'll talk about fixed income in more detail down the road once we get a clear signal from the Fed. But as always, thank you so much for taking the time.
Thank you.
Viewers, do stay tuned. Lots more coming up over the course of this evening. And this is BQ Prime.